Okay, hello everyone. Welcome to day three performance management webinar, and I'm Razwan Mania. So I hope you people are good, and the previous 2 days uh, would have helped you in raising your confidence, and yes, will give you much more uh, confidence for your examination. So day three is decision making is one of the core areas, and you can see we have relevant costing, linear programming, CVP analysis, risk and uncertainty, and pricing. So first of all, I will be starting with the very important area, and that is relevant costing. So let's first start with relevant costing, because relevant costing is important for examination. Now, what is a relevant cost? So as we are covering decision making and this is short term decision making. So in short term decision making, we use relevant costing for decision making purpose. So you need to remember that what is a relevant cost. So it's very important to understand relevant cost is basically a future cash flow. It's a future cash flow that will arise when you take a decision. So any future cash flow that results directly because of the decision is known as a relevant cash flow. So you need to remember, for cash flow to be relevant, it is important that it should be a future cash flow. So I hope this is clear. Now, there are two things whenever you need to decide whether a cash flow is relevant or not. So it's very simple. The first thing is, for any cash flow to be a relevant cash flow, it should be incremental cost or an incremental income. So any incremental cost or income is known as a relevant cash flow. So there are so many examples of incremental. For example, if you uh, are deciding whether you need to buy a shoe or not. So if you will buy a shoe, so the cost of that shoe is an incremental cost. Okay, so the cost of the shoe is an incremental cost. So if you go for a certain decision, so because of this, any cost that arises is known as incremental cost, or any income that arises is known as incremental income. So definitely I'll give you examples of these when you move towards the question. Another thing is opportunity cost. For a cost to be relevant, it could either be incremental, or I'm writing or it could be opportunity cost. So if it is an opportunity cost, that would again be classified as an incremental cost. And we all know what is an opportunity cost. Opportunity cost is basically the cost of second best alternative foregone. uh, the sacrifice that we are doing, that is known as opportunity cost. For example, we are doing a job of 100,000 and we got another opportunity of 1,20,000. So keeping in mind the financial numbers, we would want to go towards 1,20,000. So that 1,20,000 job is what we opted for, and what we left behind is job number one, and that job number one was giving us 100,000. So the sacrifice that we have done of job number one, and that sacrifice is of 100,000. So this 100,000 sacrificed is opportunity cost. So it's simple. Whatever you do, whatever sacrifice you do, that is known as opportunity cost. For a cost to be irrelevant, it could be sunk cost, any cost that is a past cost, which means had already been incurred. Now, what I mean to say had already been incurred, it's very simple. At the time of taking the decision, when you are taking a decision, so at that time of taking a decision, that cost had already been incurred at the time of decision making. So that is known as sunk cost, past cost, and it is not relevant. So past cost is already incurred. Now comes another cost that is known as committed cost. Committed cost is a cost that will arise in future, that will arise in future. And you would be thinking, if this will arise in future, so as I mentioned initially, any future cash flow is a relevant cost. So you would be thinking, okay, this committed cost should be a relevant cost. It is not. It is not a relevant cost, even though this will be incurred in future. But the commitment to incur this has been made in the past, which means at the time of decision making, at the time of decision making, are you all listening me, everyone? Hello, come on, say yes. Are you all with me? A quick yes for the confirmation. So at the time of decision making, at the time of decision making, this cost hasn't been incurred, but the commitment to incur such a cost has been done in the past. Like, for example, a very good example is guaranteed minimum wage. We have guaranteed our labor that irrespective of whatever work we have in the future, we will pay you a certain amount. We haven't paid that certain amount yet, but the commitment to pay that certain amount has been done in past. Even though we'll pay that in future, but the commitment has been done in past. So that guaranteed minimum wage is a best example of committed fixed cost. Same goes for your rental agreements. You have already done the agreements. So at the time of decision making, agreements to pay rent had already been done. Even though you'll pay the rent in the future, but those rental cost is a committed cost, so irrelevant. So it's a very simple difference. In sunk cost, the cost has been incurred in the past, whereas committed cost will be incurred in the future, but the commitment to incur has been made in the past. Notional cost, imaginary cost, any kind of absorption, any kind of cost like depreciation is not relevant. For example, any non-cash item, or I would say any depreciation, any absorption you are doing, you're working out the OARs for fixed overheads. So all those imaginary costs, artificial costs that does not exist in real, are notional and will not be relevant costs, like I said, non-cash flows and depreciations. One more thing is reapportionment of existing fixed cost. Now, this existing fixed cost is basically what? It's a committed cost. It's a committed cost because fixed cost you is a one that you already have committed. So if existing fixed cost is a committed cost, so if you just reapportion that cost to your decision, so that would not be a relevant cost. It is just because that you uh, classify this as a committed cost. So any reapportionment of existing fixed cost is a committed cost and is not a relevant cost. So two things that make a cash flow relevant and four things that make a cash flow irrelevant. And here I am making a rule of six. Now this is the key thing, rule of six. Come on, say what is this? Just write it down. This is what? Rule of six. Quickly write rule of six. So rule of six is what? Rule of six means these are the six things that you need to keep in mind for relevant costing decision making. Rule of six will make your life easier. If you're confused whether a cost is relevant or not, just see whether it's incremental opportunity. If you want to see whether a cost is irrelevant, so just quickly see, is that a past cost? Is that a committed cost at the time of taking the decision? Is that an imaginary artificial cost, or is that just a reapportionment of existing fixed cost? So the rule of six will give you the clear idea whether a cost is relevant or irrelevant. Now we use relevant costing for certain types of decisions, and the decisions are very famous. One is the one of contract. Now this decision is one that we use taking relevant costing principles, where we see whether we have to go for one-off contract or not. Now what is one-off contract? For example, any one-off opportunity that the business needs to avail in the short term. By availing that in the short term, business can get any long-term benefit. So one-off contract decision making is done using relevant costing principles. Then make or buy decisions are also conducted using relevant costing principles. That is, in short term, if we need to decide whether we should produce a product in house or buy that product from outside, so the decision of make in house or buy from outside again requires relevant costing principles to be followed. Then we have shutdown decisions, like whether we should close a certain business segment, a loss making business segment, a loss making product, a loss making department. So we have to consider that whether we should close a particular thing, a department, or a product that is showing a loss in the short run, should we close it or not. So for such shutdown decisions, we do use relevant costing principles. Okay, notional is imaginary cost, like non-cash flows, like depreciation. These are artificial costs, and they are one that do not have any real existence. So these are not relevant cost. Okay, further processing decisions are a one that the business that takes when they need to decide whether they have to process a product further, would that further processing be good or not. For example, if a company is making a petrol and that petrol is a regular petrol, okay, regular petrol, so company needs to decide whether company should sell this petrol as a regular petrol, or company should further process it and make this high octane. If company wants to make this high octane by further processing, so the decision would be whether to sell the product as a regular petrol, or we should further process this and make this high octane and sell this after making this high octane. So the decision making is whether we should sell at whether we should sell this as a regular petrol, or we should sell as a high octane petrol by further processing it. So in that, again, we use relevant costing principles. So relevant costing principles rule of 6 is used for these different situations. One off contract, I did mention that any one off opportunity, that is some work that is not a regular work for the business, and if business is getting an opportunity for one off business, using relevant costing principles, we take a decision whether we should go for this one off contract or not, because this is not our regular work. And for example, we need to win any government tender. So we know that in short run, if we use relevant costing principles and we just offer a price which is a low price and just win this tender, so once we win the tender, we will get long run business from the government. So it's a short term decision making, and one of contract is one of opportunity that the business gets, that business wants to avail in order to get benefit in the long run. So for that short term one of contract, company can use relevant costing principles. So these are different situations in which we use relevant costing principles. And the rule of 6, I would say the rule of 6 is the king here. If anyone remembers the rule of 6, they can handle relevant costing. Whatever decision making comes in the paper, whether it's a one off contract, it's a shutdown decision, it's a make or buy decision, it's a further processing decision, or even if it is something else, okay, so you can take decision very easily. So let's now use this rule of 6 and let's move towards our first examination question, a very latest examination question, a very good examination question that I just want to start from. So let's start with a very, very good question that has been tested in a recent examination as well. Okay, so here we are with this question. Uh, this is a latest exam paper of March June 2019 attempt. So yes, this will give us a very good idea how to handle questions that relates to relevant costing, and these are the one that have been recently tested. So a very good question, I would say, if someone is good in terms of calculation, so they can handle question like these if they are very clear about the relevant costing principles. So it will be really easy for them to handle such questions. Let's see how we will be approaching this question. That's so strange. After page number 7, it's page number 9 with no page number 8. Okay, so let's open again directly. Now, this is wasting a lot of precious time. Now, let's start with this question. I hope it's visible to all of you. Let me just make it more easy for you to understand. Now, Belton Park Resort is a new theme park located in the country of Beeland. The resort is made of a theme park, a hotel, and an indoor water park. Now, just keep this in your mind. I will not solve this entire question today. Rather, I will give you this question as well to solve. So make sure one thing I'll be solving here and one part I'll give you today to solve. So do understand the technique. So it's a theme. It's a resort where you have a theme park, a hotel, and an indoor water park. The resort opened 2 months ago and is already very popular. All theme parks are required by law to shut down in colder month of Jan because of the risk of accidents. Belton Park Resort must decide whether to shut down. So this is a shutdown decision. The whole resort or just the theme park. It could choose to open. It could choose to keep open on the hotel or the water park. So, since the Belton Park Resort has not been open for long, there is limited historical data available about cost and revenues. However, based on the last 2 months, the following average monthly data is available, where we can see the data for hotels and water park. So, number of rooms, average room rate per night, average occupancy rate per month, average night spent on extras per room, contribution margin for extra 60%. Please just really just focus on the data, okay? Otherwise you will lose when I'm doing the calculation. Water park information is also given to you. Extra includes anything purchased by the customer not included in the room rate or admission price. Okay, now let me just quickly go towards the requirement. Calculate the incremental cash flow for the month of January. 31 days you have to assume. If the park decides to keep open the hotel and the water park for 15 marks, in each case state whether it should remain open or should close. So you have to just take a decision and tell whether it's good to open or it's good to close using incremental cash flow. So you have to see, as it says, if the company decides to keep open. So your mindset here will be to keep open. Okay. As the question states that keep the mindset of keeping it open. Okay. If we keep the mindset of keeping it open, this is critical. So your mindset should be that if we keep this open, what will be the incremental, what will be the additional cash flow in terms of income, in terms of cost. Okay. So make sure, by looking at the question, it says if we decides to keep it open, so our mindset while doing the calculation would be that we, if I am saying if we keep it open, then what happens if we keep it open. Okay, so we have to do calculations for hotels and water park. Now hotel calculation will be done by me right now, and water park calculation will be done by you people in your homework. Okay, so I will just read hotel information in front of you right now, and we'll skip the water park information that you have to solve later on, and then tell me what the answer is. Are you ready for this, guys? Yes or no? Now management estimates that for January the average room rate per night would need to decrease by 30%. So this is important to remember, that by 30% the price will go down, and the admission price for the water park by 20%. With such reductions, it is estimated that occupancy rate of 50% would be achieved for the hotel, and that the number of visitors to the water park would be 52% lower than the current levels. Because of the January, because of the low demand, the occupancy will come to 50% for hotels. The average nightly spend on extra per room of 20 at the hotel and 12 per customer at water park is expected to remain unchanged. So we are provided with the information for the last 2 months. My focus here will be towards hotel, as water park is your job. Staff cost, maintenance, power cost, security, and water cost. And the notes are given. So what I'll do, I'll read this, and according to that, we'll do the workings. So let's start my calculations. I need to work out the incremental cash flows. Okay, incremental cash flows, and the mindset that I need to keep is, for example, if the company decides to open it. So in the month of Jan, if this if is important, okay, if the company decides to open, this is not a decision, this is just the mindset, this is just what I'm thinking. If we open, then let's see what will be the revenue, what will be the cost. I repeat, if we open, what will be the revenue and the cost. This is what I'm doing right now. Okay, and my working will be for hotels. So let's work out the incremental revenue if we open in the month of January. And you know why I'm emphasizing on the word if is because the question requirement made it clear that if the company decides to keep open, then what will be the incremental cost and revenue? Okay, so that's why I am taking the same mindset. Now, for revenue, it's easy to work out. Be with me. The price will fell 30% from the current price of 100. So current is 100 and 30% reduction will be done. So let's make a working area here where I will be performing the workings. Current price is 100. Okay, 30% reduction means let me work out the 70% of this because I need to reduce. So the price for Jan price will be $70. So 70 will be the price for the month of Jan. Clear? I hope this is clear to all of you. Secondly, it says that occupancy will fell to 50% for hotels, right? So let's see how many rooms are available. So we have 120 rooms and 31 days we have to keep in our mind. 31 days as given the question, and 90% is the current occupancy, which means other than Jan. So rooms are 120, days are 31. So we'll multiply this 120 with 31 and we will get the answer of 3720. So how much will be the occupancy? So the occupancy will be 50% in the month of Jan, which means 1860 rooms will be available, will be used. 1860 rooms will be used. So I hope this is clear to all of you up till now. The calculation that I have done in front of you, it's simple and I hope there will be no problem in such a calculation. So it's 1860. So the rooms available 1860, the price is 70. So let's work out the revenue, that is the hotel incremental revenue is 70 multiplied by 1860 will give you a revenue of 130 to 100. So this is the normal revenue of the hotel, 130 to 100. Now $20 we earn for extras per room, based on each night. So it's very simple. 60% is the contribution from that figure. 60% is the contribution margin. So it's easy to work out the extras income. That is the total rooms that will be occupied is 1860 into 20 is what we earn into 60% is the contribution. Okay, so it's 1860 nights into 20 extras per night into 60% is the contribution, which is 22320. So the total incremental inflow of opening in January will be 152520. 152520. Okay, so this is 1860. 20 is the extra revenue per day, per night, and 60% is the contribution. So this is the incremental extra income. This is the incremental hotel income, and this is the total inflows. Why we take 60%? So it's very simple, friend. 60% is the contribution. Tayyab, contribution. Obviously, we need to take contribution because variable cost will be deducted from the revenue. So we'll be left with contribution. That's why I'm taking contribution. That's it. Okay. So I hope this is clear. Now, after working out the incremental revenue, let's move towards the cost. So I've used my entire data of 30% decrease in price and 50% the occupancy level for my calculation purpose. 31 days. Now staff costs. Now what you need to think. If we open in the Jan, so what will be the incremental cost for Jan? A cost that will arise just because of opening in the January is what you need to find out. And the cost which will be considered as a committed cost that will continue to arise, a cost that will continue to arise, which means that is not incremental, that is a committed cost, which means if you open in January, that cost will be incurred. If you don't open in January, that cost will still be incurred. So that is a committed cost. So we have to find that. Okay, what is a committed cost and what is incremental that is specific to Jan? We are using rule of 6 here. Okay, so it says that staff cost for hotel is 120. Okay, permanent staff included in the staff cost for the hotel is the salary of 30,000. This is per annum, and we are doing 1 month calculation. So this is per annum. Okay, and for the hotel manager, and 24,000 per annum for the head chef. This is also per annum. These are both permanent members of staff who are paid for the full year regardless of their working hours. Regardless of their working hours. Which means whether you open in January, whether you open in January or you do not open in January, these costs will continue to be incurred. Okay, these costs will continue to be incurred. So this is irrelevant cost, and this means this is a fixed cost, or I should say this is a committed cost, and this is the example of a committed cost. So we should not consider this cost. But how we need to work out is very simple. Okay, now what I am required to do here, let me just separate this area from the main presentation area so that working area is separated. Okay, now see, staff cost. So the amount is 1,20,000, right? From this, I will deduct the committed cost, and that relates to what you say, this manager, okay, and what you say, the chef. So let's deduct the annual cost of them is 30 and 24,000. So it's simple, 30,000 divided by 12, 24,000 divided by 12. Okay, so this is 2,500 and this is 2,000. So once I deduct, so I will get 115,500, because this is not an incremental cost for January. This is not an incremental cost for January. This is a committed cost, and being committed cost, this is not relevant. This is a committed cost. Okay, so it's not relevant. I hope this is clear. Now, going back to the question, what it says, the second para relates to water park that I'm not reading. Okay, that is your work to do. Then after permanent, we have temporary. The remaining staff cost. The remaining staff cost. So how much is the remaining staff cost? Is this amount? This is the remaining staff cost. So the remaining staff cost relates to temporary staff who are only paid for the hours they work, because it's an annual cost, my friend, and I'm doing calculation for month. January is 1 month, so I need to divide this with 12. Okay, I think you missed out this figure. It's 30,000 per annum, and that is why I made this per month and then deducted from the per month figure that is given above. Okay, so this is actually each, it says each last 2 months cost. Okay, so this is the per month cost we have, and that's why I deducted the per month cost. Now the remaining relates to temporary staff who are only paid for the hours they work. If the hotel stays open in January, half of these staff members will continue to work their current hours. So half of the staff will continue to work because their jobs are largely unaffected by the guest occupancy rate. So what do you think? If you continue to open in January, you need to call these temporary staff. So the answer is yes, but 50%, 50%, 50%, uh, 50% of the staff should be, what I should say, 50% of the staff will continue to be fully occupied, and this means this cost is a relevant cost. Then this cost relates to the normal temporary staff working. So if you see, if the hotel stays open, half of these staff members will continue to work. If they continue to work, the cost will arise. So this is an incremental cost. So what I'm doing here is, let me just divide these into two areas. 50% will continue. So the 50% figure is 57750, and this is what? This is an incremental cost, because this relates to temporary staff. This is not a permanent staff. Okay, temporary staff means incremental. They work if you are open. So in January, if you're open, they will work. So this is an incremental cost. The remaining 50% is 57750. 57750. Now, what about this 50%? So let's read in the question. It says, however, the other half of the staff will work proportionately less hours to reflect the 50% occupancy rate in January as opposed to 90% occupancy rate of the last 2 months. This means the remaining 50% of the staff hours will reduce due to lower occupancy, and how much will they now work? So currently they used to work for 90% occupancy. So this cost is based on 90% occupancy right now. So from this 90% occupancy, I need to bring this to 50% occupancy. From this 90% occupancy, the cost is based on 90% occupancy. Okay, so from this 90%, I need to bring this to 50% occupancy. So how will I do? So it's very simple. This cost is based on 90% occupancy right now. 90% occupancy. So how to bring this to 50% occupancy? Simple. You need to divide this with 90 and multiply with 50%. So this cost now will be based on 50% occupancy. So currently, obviously the question did mention that currently the company is working on 90% capacity. Okay, so this cost was based on 90%, and you divide this with 90 multiplied by 100 to bring this to 50%. So the figure is 32083. So you have to consider incremental here. If you open in the month of January, let me quickly just give you a recap of staff cost. If you open in the month of January, your current cost is 120. From this, you will deduct the committed fixed cost of manager of 1 month. You will deduct the committed fixed cost of chef of 1 month, and you will left with this cost, which relates to temporary staff. Now, the 50% of the temporary staff will continue to be used in the month of January, which means this cost will be incremental and you will consider it. The remaining 50% relates to the temporary staff, but that temporary staff now will not have to work for the normal hours that they used to work at 90% occupancy, and now they will work according to 50% occupancy. So this cost is based on 90% occupancy. So we divide this with 90 multiplied by 100 to bring this to 100%, to bring this to 50% occupancy, and this is the cost that I will be charging for the month of January, which is incremental cost based on 50% occupancy. So I will add these two together. I'll add these two together, and once I add these two together, so what is the sum we have? So the sum is 89833. Okay, so staff cost incremental 89833 is the incremental staff cost if we open in the month of January that I'll take here, as I will add these two together. So is this clear, right? I hope this is clear. So we just have to take incremental that relates to the decision, and I'm making this clear so that you should understand that what I'm doing. So you need to concentrate on the numbers for sure. Now the second figure that we have is a one that relates to maintenance. Okay, now I'm using this PDF where I can write. So now we are at maintenance. So for maintenance, let's see what it says. How much is the maintenance cost given in the question? So the maintenance cost is 14,600, right? 14,600 is the maintenance cost. So let's read the note. Maintenance is undertaken by a local company, Tech Work, which bills Belton Park Resort for all work carried out each month. Okay. If the hotel and the water park are closed, Tech Work will instead be paid a flat fee for the month of 4,000 for the hotel and 2,000 for the water park. Now, it's very simple. This flat fee is what? Is a committed cost. This means this will continue to be paid even if you close it. It says even if you close it, you will pay this flat fee. So this flat fee is a committed cost whether you close in the month of January or you open in the month of January. This cost will continue to be paid, and this is irrelevant cost. This is irrelevant cost. Okay, so being irrelevant, what I'm supposed to do? Very simple. I just need to deduct this cost from the figure of maintenance, which is 14,600. So you can see this 14,600. From this, I will deduct this 4,000 irrelevant cost, that is a one that will continue to be paid. So I can simply take here maintenance cost 14,600 minus 4,000 committed one, and the incremental one will be 10,600. Okay, so I hope this is clear. The maintenance cost part, 4,000 is irrelevant for hotel, and I've just deducted this. The remaining is all incremental. Then we have power cost, 20,000. So what's about power cost written here? Power. In power, you have electricity and you have gas. Two things. So let's read for electricity. Belton Park Resort pays a fixed monthly charge for electricity of 8,000 for the hotel and 7,000 for water park all year round. Okay, so this is a monthly charge. Okay, so they pay a monthly charge of 8,000 and this is fixed, which means it's a committed cost. Whether you continue in the month of January or you discontinue it, you need to pay this cost. You need to pay this cost. So this is a committed cost of 8,000. So this means from this cost of power 20,000, I need to deduct the electricity fixed charge. Electricity fixed charge I need to deduct. So as I just show you the figure of 20,000, from this I need to deduct this 8,000 fixed charge. And once I deduct this 8,000 fixed charge, so I'm left with what? Once I'm done with the electricity, the cost that I'm left with is the remaining gas cost. Okay, so from this power cost, 8,000 I have deducted. This is a committed cost, so I'm left with 12,000 because power includes electricity and gas. So for gas, the gas charges relate to heating and include a fixed charge of 2,200 per month for hotel and 1,500 for water park. Now this again is a fixed charge and it's a committed cost. So from the total 20,000 power cost, 8,000 has been deducted as a fixed electricity cost, and now I'm deducting from this remaining 12,000 this 2,200 as well, and this is also the fixed gas cost. So I'm left with 9,800. Okay, it says the remainder, this is 9,800 of the gas charge, is based solely on usage. So this is based on usage, incremental, variable. Would be expected to increase by 50% in January because of cold weather. So this remainder is a one that is that depends on the usage, and this needs to be increased because of the cold weather in January, because you will be using more gas. So I need to increase this with 50%. We'll multiply this with 1.5 to incorporate the 50% impact, and that 1.5 becomes 14,700. So it's simple. Power cost was 20,000, fixed electricity deducted 8,000, fixed gas deducted 2,200. We are left with 9,800. The remainder, this relates to the usage and needs to be increased by 50% for January. So I've increased this with 50%, and this is 14,700 that relates to the usage, and this is incremental cost. This is incremental cost. So in my answer for power, I will be writing 14,700 as my incremental cost. That is 9,800 into 1.5 is incremental cost. Okay, so this is incremental cost. Now the next thing we have is security cost, 13,600. So let's see what it says for security. If the hotel and water park are closed, no changes will be made to the current arrangement for security while premises are empty. This means this will continue to arise. This will continue. This will remain same. No change will be made, which is making quite clear that nothing will be done as regard this cost, and this will continue to arise, which is making very, very much clear that this is what? This is committed cost. Security cost is a committed cost. Whether you open in January or you close it, you have to bear this security cost at any cost. So nothing needs to be done for this, and this will continue. Is this clear, everyone? So this is a committed cost, and nothing will be charged as far as the security is concerned. So for security, I would write there is no incremental cost, because this will continue to arise whether you close it or not. Then water. So water 12,900. Let's see what it says. It is estimated that water cost for hotel would fall to, now this says fall to 6450 for the month if it remains open in January. And second is for water. So the second is for water park. So I'm not reading for water park. So this cost will fall to 6450. So right now what the cost is? It's 12,900. So from 12,900, it will fall to 6450. Now what do you think? From 12,900, it will fall to 6450. So what will be the cost if we continue in the January? So the cost will be 6450. If we continue, so it will be 6450. Automatically, they have given us the figure. So this is incremental 6450, and this is the water cost. That's it. From the incremental revenue, we will just deduct these incremental costs, and we'll see whether we are getting net benefit or cost for opening. So after water, nothing is left, right? So after water, nothing is left. Everything is done. Now let's see what is the incremental cash flow. So can you tell me what is the incremental cash flow? It's a positive answer or a negative answer. So it's positive answer of 72562. 72562. This is a positive answer of incremental cost. And yes, this means you need to take a decision. Now let me tell you here the marking scheme. 15 marks were required for this part of the answer. From this 15 marks, 8.5 marks are for hotel working, 6.5 marks are for water park. And in this 8.5, 0.5 marks are for conclusion, which means your decision. And 8 marks are for working. 8 marks are for working. Okay, so 8 marks are for working. So what will be your decision? What will be your conclusion? So conclusion will be, should we continue? Yes, we should stay open in Jan, as incremental benefit will be 72562. Incremental benefit will be 72562. So for this you are getting 0.5 marks, and for all this you are getting 8 marks. Okay, so I hope this is clear to all of you. The calculation, I have considered the incremental costs compared with incremental revenue. and these are the workings that I've done. So I hope this is clear. It's very simple. What I personally believe is, if you know the rule of 6, any question of relevant costing you can solve by rule of 6. Any working you can do by using rule of 6 with no confusion at all. Sorry, I just wrote the wrong figure. Yeah, the net benefit. Yeah, the net benefit is 3937. Yeah, yeah, you're right. 3937. This is the net figure, net benefit. So this is the benefit. So the decision remains unchanged. And let me change here as well. It's 3937. So what you say, friends? Is this easy? Incremental revenue means additional revenue that you will earn if you continue in the month of Jan. Incremental revenue. Okay. So quickly, if you have any questions, quickly ask. Let me just make this more visible for you people on one screen. You can even take a screenshot here. You can even take the screenshot if you want to. Just take a screenshot and share in the group as well, so that everybody gets to know the working. Just take a screenshot. Okay. Question is, why should divide with 12 months? My friend, this is an annual cost. Ahmed, if a cost is an annual cost, why you don't think I should not divide this with 12? Can you see this? This is per annum. So I should divide this, right? Okay. Now this is clear. So through with the screenshot as well. And what's your feedback? Electricity cost was just a fixed cost. If you just look here, electricity cost was just a fixed cost of 8,000 and it was not relevant. Don't I'm sure you are thinking that you are in Pakistan and you pay bill according to the consumption. So right now in the question it's just 8,000 fixed, and I hope if this happens in our country, so we'll be very much happy that we are paying just 8,000 per annum whatever we use. So but this is not the case. Okay. Yeah, is this clear, everyone? Okay, so I hope you like the technique and you can later on watch the video for further clarification in the calculation as well. Yeah, this Francisco, this 5570, this 5570 is for the staff that continues to be fully used in January, and the remaining 5570 will not be fully used. So what we need to do for this 5570 is that we need to divide this with 90, because this is 90% occupancy cost and we have to bring this to 50% occupancy cost. So that's why we'll divide this with 90 and multiply this with 100. Okay. Now I cannot answer why 31 days. Okay, I cannot answer that. Why 31 days? There are certain things that you should ask the examiner yourself. Maybe examiner likes to add one more day. Maybe. Okay. So I hope this is clear. And now we are moving towards the next area. So this rule of 6. This rule of 6 is a one that will help you a lot. I hope the answer is clear to all of you. So what's your feedback? Did this made things easier for you or not? Did this make things easier for you or not? What's your feedback, guys? Tell me. Rule of 6. Is rule of 6 good? Okay. Now the next area is CVP analysis. Cost volume profit analysis. cost volume profit analysis. Okay, now you need to solve the remaining part. Then we'll solve part B. Hamza, okay? You need to solve the remaining part for water parks. So you have to solve for water parks from homework. Will you solve in the same way from homework? Yes, guys, tell me. So this is the homework, okay? Now, CVP analysis. The major calculations in CVP are weighted average for multiple products. Normally in an exam, it's multiple product situation, which means company is producing more than one products. So four calculations are important that you should know: CS ratio, contribution to sales ratio, break even point. I'm sure people know about break even point: no profit, no loss. Margin of safety, the point where uh, the area that is a safety area for the business, maybe the profit area for the business after break even, and the calculation of target profit, that how many units company needs to achieve in order to achieve a desired target profit. Okay, so these are the four important calculations of CVP analysis. But in a multi-product situation where company is making and selling more than one products, so all these four calculations are performed using weighted average workings. All these four calculations are performed using weighted average workings. So for that, what we do, we work out weighted average contribution per unit. CPU means contribution per unit, and we work out weighted average selling price per unit. So how we work out weighted average contribution per unit is total contribution for all products divided by total number of units. And how we work out average selling price is total sales revenue for all products divided by total number of units. So through this we get weighted average contribution per unit and weighted average selling price per unit. Okay, so when more than one products are being sold, so you have to perform this weighted average working of contribution and selling price, and based on these you perform all these four workings of CS ratio. So this is called as weighted average CS ratio, weighted average break even. We apply these their normal formulas and we will use weighted average figures, weighted average margin of safety. So all these will set as weighted average. Okay, so the key thing for these four calculations, the key thing is what? The key thing is weighted average working. Now the graphs, three graphs are important: multi-product break-even chart, profit volume chart, and contribution chart. A break-even chart is a one in which you see sales revenue line, fixed cost line, and a total cost line is a break-even chart. Okay, so let's now move towards another question and see how I can use the information in that question. Very, very, very superb question. Very good question. And I'm using all the latest questions so that we are covering all the latest things that are given in the paper. And I don't know what is happening here. Again, it's the same problem. Let me just minimize this. Okay, now I got it. What is happening here? It's split it into two pages. That's why I can't see the question, entire question. If I make this single page, this is nice as well. Okay, so is this visible to all of you? Okay, now, so this is a question that has been recently tested again in the paper, and that relates to CVP analysis. Okay, the Alka Hotel is situated in a major city close to many theaters and restaurants. Be with me, please. The Alka Hotel has 25 double bedrooms, 25 double bedrooms, and it charges guests 180 per room per night. Okay, regardless of single or double occupancy. The hotel's variable cost is 60 per occupied room per night. The Alka Hotel is open for 365 days a year and has a 70% budgeted occupancy rate. Okay, this is the budgeted occupancy rate. Fixed costs are budgeted at 600,000 a year and accrue evenly throughout the year. That's fine. During the first quarter one of the year, the room occupancy rates are significantly below the level expected at other times of the year, with Alka Hotel expecting to sell 900 occupied rooms night during quarter one. So that's pretty much low in quarter one. Options to improve profitability are being considered, including closing the hotel for the duration of quarter one or adopting one of the two possible projects as follows. So, one option they have, let's close the hotel, because CVP analysis is a decision making technique and it helps in taking right decisions. Other option they have is to uh, go for one of the possible options given below. Project 1. Let's see what theater package is. For quarter 1 only, the Alka Hotel Management would offer guests a theater package. Couples who pay for 2 consecutive nights, which means they need to buy the room for 2 consecutive nights, at a special rate of 67.5 per room night, will also receive a pair of theater tickets for a payment of just $100. The theater tickets are very good value and are the result of long negotiation between Alka Hotel Management and the theater. The theater cost the theater ticket cost the Alka 95 per pair. Okay. The Alka's hotel fixed cost specific to this project this is specific fixed cost, are budgeted to be 20,000. That this is the fixed cost that relates to this theater project only. Okay. The hotel management believes that the theater package will have no effect on their usual quarter one customers. This means these 900, these will continue to come. Okay, these will continue to come, who are on business travelers and who have no interest in theater tickets but still require the usual room. Project 2. This is a break even chart. I just told you, see, a break even chart shows you sales revenue line, fixed cost line, total cost line. Okay, so you can see here sales revenue line, total cost line, fixed cost line. Wow, awesome. There is a scope to extend the Elka and create enough space to operate as restaurant for the benefit of its guest. Okay, so this is what they want to open up restaurant there. The annual cost and revenue and volumes for combined restaurant and hotel. Now this is a combined graph, combined, which means the current hotel plus the restaurant are illustrated in the following graph. The graph does not include the effect of theater package, which is option 1. Now let's move towards the question and see what has been asked. Using the current annual budgeted figures, so we have to use the budgeted figure, annual budgeted figure. Ignoring the two proposed projects, just ignore the projects. Calculate break even number of occupied room nights, which is break even per unit. Break even per unit is what I need to work out. Per room, break even per room means per unit. And the margin of safety as a percentage, I need to show for 4 marks. Margin of safety as a percentage. Okay. So if I go towards the upper information and I have to ignore these two projects, so will be able to work out from this information that is available. Okay, I will be able to work out ACCA hotel break even in units. Rooms means units that we need to work out. So what is the formula? It's fixed cost divided by contribution per unit. Okay, so let's move towards the workings. Fixed cost is 600,000 for the year. 600,000 divided by contribution per unit. So 180 is the selling price and 60 is the variable cost. So 180 minus 60 will give you 120 as your contribution per unit. So easy questions have been tested lately. I don't know why people cannot pass. It's the examination pressure that is killing them. That you need to handle. So 180 minus 60, and here you have the answer of break even in terms of rooms. How many rooms you need to sell for break even? And 5,000 rooms. This means for break even, it's important to sell 5,000 rooms. It's important to sell 5,000 rooms if you need to break even. Okay. Then what I need is margin of safety as a percentage. So how will I work out? It's very simple. Formula is sales units minus break even units divided by sales units, because it requires as a percentage. So let's do the working. How much is the break even units? That I know is 5,000. How much is sales units? That I need to work out. So if I go back to the question, let's work out. 25 double rooms we have into 365 days the hotel is open. Okay. So 25 into 365 is 9125 rooms are available in the hotel throughout the year. Throughout the year, 9125 rooms are available throughout the year. It says that we work at 70% capacity. So 9125 multiplied by 70% makes 6387.5. 6387.5, which means the total number of rooms that we are able to sell in a year are 6387.5. 25 rooms we have, double rooms, 365, total rooms available are 9125. From this 9125, we sell 70%, which means we sell 6387.5 rooms. So our sales units is 6387.5. 6387.5. Okay, divided by 6387.5 gives you a percentage of 21.72%. This is margin of safety. Are you all getting my point? Margin of safety indicates the profit area. It indicates the units. It indicates the units after break even, because at break even it's no profit no loss. At break even it's no profit no loss. Okay, so it indicates units after break even, means units that are profitable units. That are what? Profitable units. So margin of safety is clear. 21.72% is the margin of safety, which means your profitable units are 21.72% of the sales. So the more the margin of safety, come on guys, are you with me? The more the margin of safety, it is good or bad for the company? What do you think? Good or bad for the company? Yeah, it's good for the company. More the margin of safety. Nice. So we are done with this 4 marks. I hope this is clear. Now, the next part says, ignoring the two proposed projects, calculate the budgeted profit or loss for quarter 1. So again, we have to ignore the two projects. 4 marks are given here. And explain whether hotel should close for the duration of quarter 1 or not. Now again, you have to explain whether the hotel should close for quarter 1 or not. So it's very much like relevant costing decision making shutdown area that we did cover right now. Don't you think? Because if we want to close the hotel for quarter 1, so this is a short term decision that we are taking, and we need to decide whether we should close this for quarter 1 only. So this means we are thinking about short term closure. And when you think about short term closure, you need to use the relevant costing principles. Wow, what a connection between CVP and relevant costing examiner made. Okay, so first of all, let's discuss the breakup. Explanation is for 2.5 marks and calculation for 1.5 marks. Wow. And our students normally think what? Calculation gets more marks and theory gets less marks. Here theory is getting more marks because you have to use the relevant costing principle of shutdown decision here for 2.5 marks. The examiner report includes this comment that students were not able to pick this 2.5 marks. They were not able to pick that this was relevant costing shutdown decision. This is the examiner feedback, and students were good in calculation, and that only scored 1.5 marks, unfortunately. So friends, let's perform the calculation. Part 2, budgeted profit and loss. So what I need for this calculation? Maybe I require contribution per unit. That I know. The selling price is 180, I guess. Yeah. And the variable cost is 60. So it's 180 minus 60. And this is 120 multiplied by. How many rooms do we expect in quarter 1? Friends, how many rooms do we expect in quarter 1? So we expect to sell 900 rooms in quarter 1. 900 rooms in quarter 1 multiplied by 900 will give you total contribution of 108,000. 108,000. Hamza, I've used a lot of spreadsheet the last 2 days because in spreadsheet it's important to understand complex calculations. So these are not complex calculations from a spreadsheet perspective. So I think if I use spreadsheet for these calculations, so student will again ask me, just show the working, just show the workings. So that's why I'm using here on OneNote, because here it's more about the calculation understanding rather than how to solve one spreadsheet. So this is the contribution that you will earn less the fixed cost. So what do you think? Should I charge the annual fixed cost or the quarterly fixed cost? This is the annual fixed cost per year. So I should charge what? Quarterly fixed cost? Yeah, quarterly fixed cost. So 600,000 divided by 12 multiplied by 3 quarter, right? So I need quarterly fixed cost, and that quarterly fixed cost is 1,50,000. So this is the fixed cost that I will incur, and the budgeted loss is how much? It's 42,000. Budgeted loss 42,000. So it's very simple, right? Budgeted 42,000. Quarterly fixed cost is what we are required to use. I hope this is clear. Now you are getting 1.5 marks here. That's it. 2.5 marks for what? For applying relevant costing principles. See, this is something we are not aware of. Wow, Majid. This is what I'm explaining right now. I never said, my friend, that this budgeted profit and loss is based on relevant costing. Now what I'll discuss is based on relevant costing. Now what I'll discuss. So, should we close for quarter one? The question is, should we close for quarter one? So, the answer is no. We should continue. Why? Why we should continue? Because this is 108 incremental contribution. This is incremental contribution. And this 150,000 is a committed cost. It's a committed fixed cost. Will be incurred irrespective. Wow. This 150,000 is a committed fixed cost. If you close the hotel for quarter one, then too you will incur this 150,000. If you will not close, you will still incur. So rule of 6, this is incremental income. Are you getting my point, my friends? This is incremental income contribution, and this is committed cost. So this means this is relevant. Wow, what a connection between CVP and relevant. Did you like the connection, guys? This is relevant cost and this is irrelevant cost. Okay, so considering this loss, we should not close. Are you getting what I've done here? Did you understand the link that I created here? That's good if you're loving it. So my friends, this is the connection. By looking at this loss, the decision will not be to close, because if you close for quarter one, it's not a permanent closure. It's not a permanent shutdown. It's a temporary shutdown for quarter one. So if you close for quarter one, you will lose this incremental contribution of 108. But you will continue to commit this 150 fixed cost, and you will be in a further loss. you will be in a further loss. So keeping in mind the relevant costing principles, we should not close this. And this was all you had to write in a paragraph for 2.5 marks, which your examiner said in its report that people missed out. People missed out. So I hope you are understanding my point here, friends. Is this clear to all of you? Give your feedbacks. Where are you guys? It's a unique link that I've created in front of you. I give break at 9:30 sharp. Okay. So I hope this is clear. So you can see here that in my calculation, I have worked out the budgeted profit and loss. And based on this loss, what one would say, close it. But we will say, no, we will not close it, because this is a committed fixed cost that will be incurred irrespective of you close it or not, and this is your incremental contribution that you will lose. So as we have just completed relevant costing, so still you saw relevant costing principles have been used here. So Rubab, is this clear? I hope you are not confused anymore. Everybody, is this clear? So the comment had a weightage of 2.5 marks. Friends, everything okay? Understood? Great. Now, the next part. What's the next part? Let's prepare for the next part before the break. And you just think what you need to do, okay? Calculate break-even point in sales value. In sales value, okay? We need to work out break-even in revenue. And explain whether hotel should adopt the project or not. So this is just for project 1 only. So we need to work out break even for project 1, the theater package. We need to work out for theater package. Are you getting my point? For theater package. Again 2.5 marks for explanation and 1.5 marks for the break even answer. So let's work out break even for theater package. So we just need to work out for theater here. We just need to work out the break even for theater package. Okay. Now, you think how will you work out the break even of theater package? I'm giving you a 5-minute break here, and you think how will you work out the break even for theater package? This is the theater package information. Okay. So please just think how will you work out the break even for theater package. And your break starts now, and that is of 5 minutes. So, let's start with the working. So I asked you to work out the break even, right? For the theater project. Now let's perform the calculations. Break even in revenue for theater project. Okay. So first of all, we need fixed cost. So how much is the fixed cost? So as I am only calculating for the theater project, so I will use theater specific fixed cost. So I will use theater specific fixed cost only, and that is 20,000. Okay, theater specific fixed cost is what I will use, and I need to divide this with CS ratio. So I need CS ratio of theater specific. So for that, what working I need to perform? So it's very simple. It's very simple. 67.5 per night cost, per night rate, and you need to go for two consecutive. So first of all, revenue 67.5 multiplied by 2 is 135. The hotel revenue of 2 nights. Hotel revenue of 2 nights. Okay. Second, we need to work out the revenue that they will receive from the tickets. That is 100. So ticket revenue of 100. So this makes 235 per theater. Okay. So this is per theater. It's 235. Now the cost, variable cost. So what is the room cost? So the question says room cost is 60. You can see 60 here multiplied by 2 is 120, and the ticket cost is how much? Ticket cost is 95 a pair, so it's 95 ticket cost. So the room cost is variable, ticket cost is variable, and what is the contribution per unit for theater? It's 20. Contribution per unit is 20. So it's 20 per unit for theater. I hope this is clear to all of you. Okay, 20 per unit for theater. Now after this 20, what are we supposed to do? We need CS ratio. So contribution of 20 divided by selling price of 235 will give you 8.51% as CS ratio, contribution to sales ratio. Contribution to sales ratio of 8.51. So this is all theater specific, guys. Is this clear? Theater specific working that we need to do. This 20 is cost per unit. Cost per unit. Sorry, not cost. Contribution per unit of 20. So the ticket cost is 95. room variable cost is 120, room revenue of 2 nights is 135, ticket revenue is 100. Because it's a deal. In theater, it's a deal. You can see couple who pay for 2 consecutive nights. So how can I work out per night then? If it is 2 consecutive nights for theater package, they will be given one ticket. They will be given one ticket when they pay for 2 consecutive nights. Okay. So contribution per ticket is worked out. Now I'll divide this with CS ratio of 8.51% and I will get break even answer of $235,000. This is break even in revenue, $235,000. Okay. So Parvez, I think this is clear. Calculation of 2 nights is just because that one ticket, if you need to pay for 2 consecutive nights. That's why two for theater package. So it's break even of 235,000, and this is what I need to work for 2 nights. So this is the contribution and break even answer for theater project. Clear everyone? Are you all with me? Now the explanation part that will give you 2.5 marks, as 1.5 marks are for this one and 2.5 marks will get for the second one. This 60 is given in the question, my friend. You need to concentrate in the question. It's variable cost of 60 per room, and 120 is 60 into 2 because 2 nights cost is 120. So 60 into 2 is 120. Okay, yes. So this is 60 into 2 is 120, right? Because 2 night cost. Now, explanation for 2.5 marks. So this is the break even revenue, right? This is break even revenue. Break even revenue. Now we need to explain whether it's viable or not. This is very important to understand. This explanation is really important to understand. And what is important here? So try to understand what is important here. So this only relates to quarter one, right? This is a quarter one deal. So in quarter one, let's see, in quarter one, the usual customers will be 900. Okay, 900. The usual customers will be 900. And let's see quarter one capacity. What quarter one capacity? So the total capacity that we have worked out was 9125 rooms. See, 9125 room was the total capacity. 25 rooms into 365 is 9125 rooms is the total capacity. So from this total capacity of 9125, I will divide this with 4 so that I get quarter one capacity, and 9125 divided by 4 will give me capacity of 2281 rooms. 2281 rooms. Okay. So total capacity is 9125 divided by 4. So I'll get the answer of 4, and this is the capacity of each quarter, and 900 are the usual customers. This means these 900 are not impressed by the theater package, as the question stated here. In the question, you can see very clearly that these 900 will continue who are business travelers and who have no interest in theater tickets. No interest in theater tickets. No interest in theater tickets. Okay. So, friends, if they have no interest in theater tickets, so these are the normal customers. Now, how much rooms will be available for theater customers? So, if I deduct here 2281 minus 900, these are the usual customers. So, the theater customers availability will be for 1381 rooms. 1381 rooms will be available for theater customers. Okay, 1381. 900 are the usual ones. Total capacity is 9125 divided by 4. Quarterly capacity is this one. From the quarterly capacity, I deducted the 900 usual customers that will continue to come. My friend, we are working for quarter one. I'm talking about the total capacity, and that 70% related to the current 70% capacity. We are assessing this project option of theater 1. Please just focus. Okay, so it's 1381 rooms available for theater customers. Now let's see how much is needed for break even. So the break even revenue that we have worked out is $235,000, right? Break even is 235,000 in terms of dollars. And if I need break even in terms of rooms, so what I'll be doing here is I'll use this 20,000 fixed cost and we'll divide this with contribution per unit. So that is 20. Contribution per unit of 20. So once I divide this with contribution per unit of 20, this gives me the answer of 1,000 theater packages will be required for break even. 1,000 theater packages will be required for this break even. 1,000 theater packages will be required because the entire working is for theater packages, right? So this is also theater packages. This is break even revenue of 235,000 for theater packages. Okay, so 1,000 theater packages will be required, and each theater package, listen very carefully, and each theater package means 2 nights will be required. 2 nights will be required because the question stated that for each theater package, couple who have to pay 2 consecutive nights, which means 2 nights will be required for each theater package. So if 1,000 theater packages are required for the break even, into 2 means 2,000 rooms will be required for break even. This is break even. This is break even of theater packages. Are you getting the point? And each theater package requires 2 nights. So this means 2,000 rooms will be required for break even. Are you all getting how technical the question is? The working that we have done here relates to theater packages only. Now, how many rooms are available? How many rooms are available? 1381. And how many are required for break even? 2,000. So, not viable. So, not viable because 2,000 required for break even in terms of rooms, and available rooms are available rooms are how many, guys? Available rooms are how many? 1381. 1381 is the available rooms. So this is not a viable option. See how we have to comment. So let me quickly give you a recap of the working that I did. We wanted break even revenue for theater project. So we took theater specific fixed cost and theater specific contribution to sales ratio, which I worked out how. For each theater ticket, we required 2 nights, and the cost of the room is 67.5, which means 135 revenue for 2 nights for each theater ticket, and each ticket revenue is 100. So there's 235 revenue per theater ticket. Okay. Then we worked out the cost. Cost of 2 nights is 120. Ticket cost is 95. So the contribution, when you deduct 230 from 235, the remaining figures, so your contribution per theater ticket of 20. Contribution per theater ticket of 20. Okay. So I worked out the CS ratio by contribution and selling price. And like this, I worked out the revenue break even for theater project. This is in revenue terms. But if I divide this with contribution per unit, so I will get the break even in terms of units, which means 1000 theater packages are required, because ticket cost is not for 2 nights. Room cost is for 2 nights, my friend. Room cost. So 1000 theater packages are required for break even. And each theater package requires 2 nights. I don't know why you are not getting, because it's very clearly written here 2 consecutive nights are required for one theater package. Okay. So 2000 theater packages are required for break even, and one package requires 2 nights, which means 2000 rooms will be required for break even. Now, how many we have? So the quarterly capacity of the room is 2281. From this total capacity, I divide this with 4 for each quarter, and 900 are the usual customers. So 1381 rooms are available, and break even is at 2000. So if break even is at 2000 and we just have 1381 available, so it's not viable to invest. It's not viable to invest. Okay. True. So this is what you have to comment in a paragraph form for 2.5 marks. 2.5 marks. Yasir Khan, is this clear? Each theater package requires 2 nights. Okay. So 2.5 marks. Are you all with me, guys? Come on, tell me. Is this clear to all of you? Okay. Now, one more part for you to solve. One more part for you to solve. Certain things I'm telling you here. And then you have to draft yourself. Okay. Using the graph, quantify and comment upon financial effect of project 2 on the ALCA Hotel, 8 marks. 4 marks for calculation, 4 marks for theory. 4 marks for theory. So, if we go for that hotel, restaurant, so let's see what happens. We are given with the numbers that at 8,000 rooms, revenue will be 2,000. At 8,000 rooms, the cost will be 1560. At 8,000, the fixed cost will be 800. So I'm just giving you a few hints, and then I want you people to solve this. 8,000 divided by, sorry, it's the vice versa. Revenue of 2 million divided by 8,000 rooms will give you what? Selling price per room. Okay. Now, the fixed cost will be 800. The fixed cost will be 800. So this is after the project. So you can compare this with the current fixed cost. And how much is the current fixed cost? And yes, make sure this data is for the entire year, not per quarter. So the current fixed cost is 600. 600. So how much will be the increase in fixed cost? I'm giving you the idea how you need to approach this. Is 600. So you can compare and see the fixed cost will increase by how much? 200 because of the hotel, your restaurant project. Okay. So you can work out the current selling price. You can compare with the current selling. You can work out this new selling price with the current selling price. You can compare. You can compare the new fixed cost with the current fixed cost. And like this, you have to comment. So using the graph, quantify and comment upon financial effect of project 2 on ALCA Hotel. You solve this from homework. I've given you just a quick idea what you need to do, and the idea was very much clear that you can use these numbers to work out the selling price per unit after the restaurant, fixed cost after the restaurant, and compare with the current. So what actually you have to do? Simple, compare the current situation with after the restaurant, after the restaurant. Okay, by using the numbers, by using the graph. The examiner feedback was that people were able to solve this. Yeah, you need to compare. See what you can compare. You can compare break even, the current break even with this break even. You can compare the current margin of safety with margin of safety. So listen, you can compare sales. You can compare total cost, the current total cost with this total cost. You can compare the current fixed cost with this fixed cost. You can compare the current break even with this break even. You can compare the current margin of safety with this margin of safety. 5 things you can compare and write. That's it. 5 things you can compare and write. I hope you are getting my point. So I want you to draft this answer for how many marks is this for? So this is for 8 marks. So it's a comparison that you have to do. Yeah, this will be on word processing sheet. Word processing sheet. Okay, friends, are you ready for the second homework? Come on, tell me. Two things you need to do. One for relevant costing, one for CVP. So compare the sales, total cost, fixed cost of current with the proposed one, break even and margin of safety of current with proposed one, and we'll discuss, or I'll tell you the answer later on, what actually you are required to do. So I hope this is clear, and this question is also clear to all of you. Multi-product contribution chart is a one in which you show sales revenue line, variable cost line, and total cost line. There is no fixed cost line here. We show variable cost line instead of this. This is a section C question, Zohaib. This is a section C question. Multi-product profit volume chart shows you the profit and loss line, in which we make two lines, highest CS ratio line and constant mix line. Right now, the graph I just saw was the break-even graph. So I hope this is clear. Now, moving towards the next area of risk and uncertainty. So, very quickly, risky situation is a one in which you have probabilities. Uncertain situation is a one in which you do not have probabilities. Do not have probability. Okay. There are four decision maker. Risk seeker is a one who wants to take high risk. High risk. Risk averse takes very low risk. Actually, he tries to avoid risk and takes very low risk. Risk neutral goes for the most likely result. Most likely result. And sore loser takes decision on the basis of future regrets. Takes decision on the basis of future regrets. Okay. So, risk averse decision maker uses expected value. Sorry, risk neutral decision maker uses expected value. Risk seeker uses maxi-max technique. Risk averse uses maxi-min technique. Okay. Sore loser uses minimax technique. So I hope this is clear. I have easily fixed the four decision makers with four techniques. Expected value is a long-term average, is used by risk neutral, maximax seeker, maximin averse, minimax sore loser. So this is known as decision rule. Okay, decision rule. Now, very important thing. Risky situation is a one in which we use expected values. Why? Because in risky situation we have what? Probabilities. And EV does use what? Probabilities. EV does use what? Probabilities. So in risky situation we use expected value because expected value uses probabilities. In uncertain situation we use decision rule. In uncertain situation we use what, guys? Decision rule. Because in decision rule there are no probabilities. So maximax does not use probability, maximin does not use probability, minimax regret rule does not use probability. Okay. So let's sum up. In risky situation we use expected value. See, I'm making this very simple, summarized for you. Listen, in risky situation we use expected value, and expected value is used by, come on, tell me, risk neutral. See, risk neutral. In uncertain situation, we use decision rule. Decision rule. Okay. Decision rule number one. Decision rule number one. Maximax used by risk seeker. Decision rule number two. Maximin used by risk averse. Decision rule number three, minimax regret rule used by sore loser. What a summary! What a summary! So I've connected risk and uncertainty with the techniques and techniques with decision makers. The situation has been linked with technique and technique has been linked with decision makers. Come on, guys. Do you like this? Are you all with me? Yes or no? This is clear. So the situations have been linked with techniques and techniques have been linked with decision makers. What's your feedback? Easy or difficult? Okay. Now let's move towards another question. So it's raining questions right now. Let's start with this question. Okay. So Milo runs a cafeteria situated on the ground floor of a large corporate office block. Uncertainty. In uncertainty, Abid, I did mention we use decision rule. And decision rule means maximax, maximum, minimax regret rule. Because in uncertainty, you don't have probabilities. And these techniques do not use probabilities that you will see right now. So each of the 5 floors of the building are occupied and there are in total 1240 employees. This is an MTQ. Milo sells lunches and snacks in the cafeteria. Okay. The lunch menu is freshly prepared each morning and the company has to decide how many meals to make each day. Now, this is what the company needs to decide. This is decision making. This is what company needs to decide. This is decision making. As the office block is located in city center, there are several other places situated around the buildings where staff can buy lunch. So the level of demand for lunches in cafeteria is uncertain. Okay. So what you need to decide is how many meals to make, but you are not sure about what. We are not sure about demand. Okay. The company has analyzed daily sales over the previous 6 months and established 4 possible demand levels and their associated probabilities. He has produced the following payoff table to show daily payoffs. Now, this is a payoff table. Payoff means returns. Returns of your actions. So, if you invest, you earn profit. Profit is a payoff. You invest, you incur loss. Loss is a payoff. Okay. So it's return of your actions. Now, you can see payoff table and remember this payoff table is a two-way table which shows two things. Always in a payoff table, there are two things. One is decision alternative and second is State of nature. You are even required sometimes in the examination to prepare this payoff table. So that is why I'm telling you a payoff table is the one in which you have decision alternatives and you have state of nature. Decision alternatives and state of nature. Okay. So do keep this in your mind. This is $1 million point. Something that is in the control of a decision maker. Something that is, carefully listen what I'm saying. Something which is in the control of a decision maker is decision alternative. That is, company needs to decide how many meals to make. 450, 620, 775, 960. This is something that is in the control of decision maker. So something which is in the control of decision maker is what? Decision alternative. Understand? So whenever you read a question and you are not sure what is decision alternative, just think in the question that is this in the control of the decision maker, and if you say yes, so this is decision alternative. Second, something which is not in the control of the decision maker is state of nature, and that is demand. You cannot control demand. Cannot control demand. So something which is not in the control of the decision maker is what, friends? State of nature. And another shortcut to find out what is state of nature in the paper, another $1 million shortcut. Are you ready for this $1 million shortcut, guys? Tell me. Another $1 million shortcut is what? when when probabilities are attached. So it's very much likely that probabilities are attached with what? With state of nature. Probabilities are attached with state of nature. Okay, so you can see probabilities are attached with state of nature. So these demand is state of nature. It's not compulsory that it is on x-axis or y-axis. It could be anyways. So something that is in your control is what, friends? Is what? Come on, tell me. Is decision alternative. Something which is not in your control is what? State of nature. And which state of nature? Usually you will see what? You are not replying, my friends. With state of nature, you will see what? You will see probabilities being attached. So in short, when in the paper you are required to make a payoff table, just keep this in mind and find what is in the control of the decision maker, that is DA. Something which is not in the control of decision maker is state of nature. And with state of nature, what you will find? Tell me, come on. With state of nature, what you will find? You will find probabilities. Because you cannot control, because you don't know what will happen, that is why you have probabilities. That is why you have probabilities, because you cannot control. So this is a payoff table where you can see daily payoffs. Payoffs, as I mentioned, payoff could be what? Payoff could be profit, loss, whatever it is. So these are basically the payoffs, which is the profits actually the company will earn. So is this clear about DA and Sun, everyone? Now, if Milo adopts a maxi-min approach to decision making, which daily supply level will he choose? No, Majid, this is the trick, my friend. It is really important to find out because that is demand. And when you want to match the demand, so you keep your supply according to demand. Okay? Yeah, you are right. But Rabia, it is basically in general, if you see risk and uncertainty is used in general terms. They do have a specific meaning here. So here it is written above it is written uncertain. So that is not, that means generally it is written. Okay. So specific definitions are risk and uncertainty with and without probabilities. So above it is written generally. Okay. Now maxi min approach. So see, maxi-min, maximum from minimum. What this means? This means from minimum payoffs. From minimum payoffs, select maximum. Are you getting my point? From minimum payoffs, select maximum. So let's see what are the minimum payoffs. So what is decision alternative? Either we'll make 450 supplies, either we'll produce 620, or we'll produce 775, or we'll produce 960. Okay. So in 450, what is the minimum? 1170. In 620, what is the minimum? 980. In 775, what is the minimum? 810. In 960, what is the minimum? 740. So from the list of minimums, we are selecting the maximum. We are selecting the maximum, and that maximum answer is 908, sorry, 1170 maximum. So the answer is A. Now the question is, why a risk averse person uses this? Why a risk averse person uses this? Because risk averse is a one who is not very much happy to take risk. He tends to go for a very low risk option, and he is conservative by nature. What is he? He is conservative by nature. Conservative by nature. So person who is conservative always thinks about worst options. That is, he says, if I produces 450, so the worst outcome would be it's same right now. If I produce 620, the worst outcome would be 980. If I produce 775, so the worst outcome would be 810. If I produce what you call 600 and 960, so the worst outcome would be 740. So ours is a conservative person who always considers the worst outcomes, and from those worst outcomes he says go for the best one. So that is why from the minimum payoffs we are selecting the maximum, because risk averse is a person who uses negative mindset, who is negative by nature, and who always says, okay, I will go for the lowest option, as he thinks negatively. So from the list of negatives, he will select the maximum. I hope this is clear, and this connection is also clear. This understanding is also clear. Yes, what you say? Yes or no? Is this okay, everyone? Then comes minimax regret approach. Are you all with me? Not replying very fast. For this, we need to make a regret table. For this, we need to make a regret table. Very much similar to payoff table. So how will we make a regret table? Let me just show you. 450, 620, 775, 960. Again, in demand, what options we have? 450, 620, 775, 960. I'm short of space here. I hope you will manage. Okay. Now, when you make a regret table, what we do? We work out the future regrets. How do we work out future regrets is a question. How do we work out future regrets is a big question. It's simple. It's pretty much simple. Let's assume if the demand comes out to be 450 in the future. If, okay? If the demand comes out to be 450 in the future, tell me which DA will provide you the highest profit. It's 1170. If the demand in future works out to be 450, so the highest option is 1170. Okay. Now, if you select this highest 1170 and this is the highest, so will you have any future regret by selecting 450 today? No. You will have no regrets for selecting 450 today because 450 is the highest and you selected the highest. There will be no regret. Okay. Secondly, what? Now, if you select 620 and the highest is 1170, as I mentioned here, and if you select 620, so how much will you earn? 980. So how much will be your regret in that case? You will have a regret of 190 and you will say yourself, oh, what I have done. If I would have selected 1170, so I would not have regretted today by the amount of 190, because this 980 is less than 1170. And like this, you work out the regrets for all other options. The highest is 1170, and if you opted for this 810, so the regret would have been how much? 360. Are you all getting? If highest is 1170 and if you have gone for this 740 option, so your regret would have been 430. You are working out future regrets. And like this, you have to do for others as well. Now, if you assume that if the demand in future is 620, so in 620, what is the highest here? It's 1612. And in the same way, you start deducting. So the highest is 1612, and if you went for this 1170, so the regret in that case would have been how much, guys? Are you all with me? 442. Second case, it's 0 because you've selected 1612. In third case, what's the regret? 217. In fourth case, it's 322. Are you all with me? If you just assume that if the demand is 775, so where is the highest? Here. So start deducting one by one from this highest. So the regret in first case would be 2015 minus 1170, and the regret is 1326. Second, it's 884. Third, it's 0. Fourth, it's 230. And for the last one, the highest is this amount. So the regret is 8. So I just a mistake, small mistake. I just wrote this wrong. For 775, it's 845. Okay, it's 845 regret. Yeah, it's 845 regret, and it's 403. It's 403. Okay, 845, 403, then it's 0, and then at the last it's 230. For the last one, it's 1326 regret, 884 regret, 481, and it's 0. Okay, so I hope this is clear to all of you. Now these are the regrets. So how will we take a decision, guys? How will we take a decision? These are the future regrets. Now the rule is, from maximum regrets, select minimum regret. It's the other way around, right? From maximum regrets, select minimum regret. So let's find out the maximum regrets in the question through this regret table. So let me just write here maximum regrets. I am creating a new space here. Now the focus should be on decision alternative. Okay, decision alternative, because you have to decide about DA. So in 450, the maximum regret is coming where? The maximum regret is coming where? 1326. From 620, the maximum regret is coming where? 884. In 775, the maximum regret is coming where? 481. From 960, the maximum regret is coming where? It's 430. So from maximum regrets for each DA, for each decision alternative, from maximum regrets, we'll select the minimum regret, minimum future regret, and that is what? 430. So this is D. Which decision maker uses this? Is sore loser, who decides on the basis of future regret. Future regret. Everyone, are you with me? Is this clear? Are the calculations clear to all of you? Going good or not? Decision making area. Okay. Now, which of the following statement is or are true? If company chooses to use expected value to assist in his decision making regarding the number of lunches to be provided, Milo could be considered to be taking a defensive and a conservative approach to his decision. So is this true or false? This is false, because expected value is used by risk neutral. Brother, from maximum regrets, we need to select minimum. Okay? From maximum regrets. From maximum regrets. So that's why I just made a list here. If you just see, these are maximum regrets. From that, I need to select the minimum one. Okay? Shanze, is this clear? Okay, so first statement is what? False? Yes, because defensive and conservative approach is used by risk averse, and risk averse never uses expected value. Is this clear to all of you? Hello, everyone. Uh, Francisco, the final decision that we'll take will be based on my friend the decision alternative. So final decision that you will take will be based on decision alternative. Like either we should make 450, 620, yeah, supply side. You are right. Okay. Expected value will ignore any variability which could occur across the range of possible outcomes. Is this true or false? This is true because expected value is an average answer. It's an average answer and it does not consider variation. It provides you a mean. It provides you an average answer. Whenever we work out expected value, what we get? We get an average answer. We get an average answer. Okay? So it ignores variability. Expected value will not take into account the likelihood of different outcomes occurring. Is this true or false? This is false because it does considers the likelihood of different outcomes occurring by using probabilities. It's false. Are you all getting my point? Expected value can be applied by company as he is evaluating a decision which occurs many times. Yes, expected value assumes that decision is a repetitive decision. Expected value is used for those projects where repetition is highest. Where repetition is highest, expected value is used for those projects. Are you getting my point, friends? So it's true. Okay. So the answer is B. Now, now I'm coming towards this question. As I mentioned in my presentation, these three are the techniques used by different decision makers, and expected value is used by risk neutral. The other techniques include sensitivity analysis, decision trees, simulation. Decision tree is used for making multiple decisions at a same time. Multiple decisions at the same time, we use decision trees. What is sensitivity? Sensitivity identifies the most critical variable. Identifies the most critical variable. So let's now move towards the next part. Which of the following statements are true regarding sensitivity of the investment? Now listen, whenever you need to find out sensitivity, So the formula is very simple. Profit divide by the variable. Profit divide by the variable. If you need to work out the sensitivity of certain things, for example, I need to work out sensitivity of selling price. Selling price. So what I'll do, 385 is my profit and I'll divide this with selling price. But for selling price, what we use? We use sales revenue. So for selling price, we use what? Sales revenue. So if you're required to work out sensitivity of selling price, you can use sales revenue, which is 1300. Now, can you tell me what the answer is? It's simple. 385 divided by 1300. It's 29.6%. Now, what this means? It's very easy to understand. Sensitivity identifies the most critical variable, okay? It's very easy to understand. Just listen very carefully what I'm saying. That if the selling price decreases, if the selling price decreases by 29.6%, so if the selling price decreases by 29.6%, just imagine if the revenue decreases by 29.6%, so how much amount will be that? So if you work out 1300 multiplied by 29.6%, and the answer would again be 385. Obviously 385. So if your revenue goes down by 29.6%, this means it reduces by 385. Okay, see, if it reduces by 385 and all other remain constant, this is the assumption of sensitivity, that all other will remain constant. So if all other remains constant and if revenue goes by down by 29.6%, which is 385 of 1300, right? Which means your profit will also go down by 385 and will come to zero. Wow, very simple. Formula is profit divided by the variable. Variable means any variable for which you need to work out sensitivity. You use this formula. So 29.6%. If the revenue goes down by 29.6%, this is 385. If it goes down by 385 and all other things remain constant, so the profit would go down by 385 and will come to zero. So a reduction in selling price by 29.6% will bring the profit to zero. Okay. Now let's work out for sales volume. So what are, okay, let's forget about sales volume. Okay, let's forget about sales volume. Let's work out for fixed cost. Fixed cost. So what will be the formula? Very simple. Profit is 385 divided by 70. Come on, what is the answer? Can anyone tell me? 550%. Are you all with me, guys? Come on, tell me. The answer will be 550%. So if the fixed cost increases by 550%, because this is a cost, increase in cost will bring profit to zero. So if your fixed cost increases by 550%, how much will be that? So 70 multiplied by 550% is what? 385. So if your fixed cost increases by 550%, this means it increases by 385. And if if fixed cost increases by 385, the profit goes down by what? 385 and will be at zero. This means fixed costs increases by 385 and all other things remain constant. This is the assumption. This is the assumption. All other remain constant, so the profit will be zero. So 550% increase in fixed cost will bring profit to zero. 29.6% decrease in revenue will bring profit to zero. Now, if I ask you to work out for contribution, what will be your answer? Can you tell me quickly? 385 divided by 455 for contribution. What is the answer, guys? The answer is 84%. Now, contribution is a positive thing, right? A positive thing. So I would say increase in contribution. Increase in contribution will bring, I beg your pardon, decrease in contribution will bring profit to zero. So for any positive figure, any positive cash flow, remember decrease of that will bring profit to zero. And for any negative figure, the increase of that will bring profit to zero. For any negative, it's increase. For any positive, it's decrease. So if contribution decreases by 84.6%, this is 385. So the profit will be zero. Okay. Now let's work out for variable cost. Quickly, for variable cost. 385 divided by, what is the variable cost? 845. 845. So what is the answer? Can anyone tell me? It's how much? 45.5%. And this is a cost. So for cost, what I should write? Increase or decrease? The increase in cost will bring profit to zero. Increase. Now, out of all these, which is the most critical one? Out of all these, which is the most critical one? That has a lowest percentage. Lowest percentage. Lowest percentage. So lowest percentage is of, let's check. 45, 550, 29.6, 84.6. Which is the lowest percentage? Is sales. And sales is the most critical variable. Most critical variable is sales. Sales is the most critical variable. Okay. That has the minimum percentage change, can bring profit to zero. The one that changes by a small percentage and brings profit to zero is the most critical one, but it assumes that only one variable will change at a time. Now, if you are asked for sales volume, as you see here, so for sales volume, we use contribution. For sales volume, we use contribution. So whenever you require it for sales volume, we use contribution. Now let's solve the MCQ. The investment is more sensitive to a change in sales volume or sales price. For sales volume, I will use what? Contribution. So compare these two. Which is the most sensitive one? Sales price or sales volume? So it's sales price. So this is wrong. Sales price is more sensitive compared to sales volume. Okay, guys. For sales volume, what we use? We use contribution. Second, the variable cost increased by 44, the investment will make a loss. Is this true or false? Is this true or false? This is false. This is false. Because you see, for variable cost, the sensitivity was 45, which means the profit would go to zero when variable cost increases by 45%. 45%. But it says if it increased by 44, so no, investment will not make a loss because investment will be at zero when it reaches 45%. Third, the investment sensitivity to incremental fixed cost is 550. Is this true? Yes, this is true. This is true. This is true. Okay? This is true. And margin of safety is 84.6. So you can work out margin of safety in terms of percentage. And once you work out margin of safety in terms of percentage, this is right. So you can work out margin of safety in terms of percentage, which is very much simple. So once you work out, you will get this answer, and D is the right answer. For margin of safety, we need break even. Okay. And for break even, we are given with the fixed cost. And I will divide this fixed cost with contribution per unit. So this is 455 for how many units? 650 units. So once I'll divide 455 with 650 units, the answer I'll get is 0.7. So once I divide with 0.7, so the break-even answer that I will get here is 100 units. Okay, 100 units. Now you can work out the MOS. It's simple. 650 minus 100 divide by 650, and you will get the answer of 84.6%. So I hope this is clear to all of you. 84.6%. So I hope sensitivity is understood by everyone. Okay, and I just explained this very differently by solving a very small question. I'd explained sensitivity. I hope this is clear to all of you, right? What's your feedback? Now, is sensitivity clear to all of you guys? Come on, tell me. Sensitivity identifies the most critical variable, but it assumes one variable will change. It assumes one variable will change, which is wrong. Which is wrong. Which is a very tough assumption actually. Multiple variable can change at the same time. So simulation is what? Simulation assumes that multiple variable changes will occur. Simulation assumes multiple variable changes will occur. So sensitivity assumes one variable change, whereas simulation assumes multiple changes will occur. Simulation is a technique through which we consider multiple variable changes. So This is the calculation part of simulation is out of our syllabus, so don't be confused about that. This is out of our syllabus, so we don't have to uh, bother about that very much, and you just need to be relaxed. As well as for simulation, no practical example, Rabia, for simulation, because simulation assumes multiple variable changes, and this is out of our syllabus. When it comes to calculation, the theoretical thing that you need to remember is this is a technique through which we assume that, okay, selling price will change, variable cost will change, fixed cost will change, things will change at the same time. So this is the assumption that we take. Whereas sensitivity assumes that there will be just one change at one time. Linear programming very much now will be tested in section C when the graphs will be given to you. So it is used for profit maximization and cost minimization. There are general steps. Define variables, and these variables basically are your products. Objective function is based on your contribution or your cost. It all depends whether it's profit maximization or cost minimization. Constraint means limiting factors. Yes, sensitivity calculations are included, and I did the calculation, Rafe. You didn't saw the previous question. I did solve the entire calculation. Okay. Identify non-negative constraints, convert inequality to inequalities, graph each equation, identify the feasible area, identify the points in the feasible area. There are two methods to find out the answer. One is by inspection method, one is by ISO contribution line. So the most famous is ISO contribution line, that is tested in the examination. Now let's quickly move towards one more question, and that question relates to linear programming. Okay. Abid Shah, solvent cost minimization is it has never been tested yet in the paper, but so you focus more on profit maximization, I would suggest. I'll over the class at 11:15 again, okay? As I need to discuss one more question, so I want you people to be with me till the end. Okay. Now, this is a question of linear programming, and I just first quickly want to give you certain quick understanding based on this question. Now, let's start with this P part. Several months later, the demand for both cakes and cookies has increased significantly to 20,000 and 15,000 per month. So there are two products, cakes and cookies, right? So these are the products. However, the company has lost the contract with Encompass Health, and after suffering from further shortages of supply. So this shortage of supply is what? It's a limiting factor. Shortage of supply of beta, Singer and its labor force the company has decided to stop making shakes at all. Okay, so company used to make 3 products, but now the company has restricted itself to cakes and cookies only. Many students say me that in a linear programming question there are 3 products. Never possible. In a linear programming question, 3 products are never possible. Okay, so it says that the variable x is being used to represent cakes and variable y represents cookies. Now this is a graph. I just quickly want to give you a quick thought about this graph. Quickly listen what I'm doing. You can see here, if I just keep my steps and the graph together, first we define variables. So right now the variables are cakes and cookies. One is on x-axis and one is on y-axis. We construct objective function. Objective function is basically our contribution. It represents our contribution. Okay, so you can see here contribution is given here, which is 2.6 we'll earn on x plus 1.75 we'll earn on y. This is our objective function. We need the optimum answer where we need to maximize our contribution. We need to maximize our contribution, which is normally the learning curve situation given in the paper. Okay, then limiting factors. So see, Singer, inequality, this is less than, this is less than, this is less than. Less than means that the maximum available you have is 12,000 for Singer, maximum available for beta is 12,500, maximum available labor hours are 3,000. That's it. And these are limiting factors which are known as resource based. What we call these? Tell me. Resource based. What we say this? Tell me. Resource based. Okay, so these are resource based. You see further limiting factor here, these, and these are known as demand based. What we call these? Demand based. This means X cookies, we cannot produce more than 20,000 cookies. We cannot produce and sell more than 20,000 cookies. We cannot produce and sell more than 15,000. Sorry, I beg your pardon. We cannot sell more than 20,000 cakes. We cannot sell more than 15,000 cookies. This is demand based limiting factor. Demand based means the market has restricted your demand. For example, the market says that you cannot sell more than 20,000 or 15,000. This is a demand based limiting factor. And what is a resource based limiting factor? It is very simple, that the hours available or the kgs available are restricted to a certain amount. Okay, so what we do is we convert these into inequalities, as you saw, less than or equals to. Like this, we also have another one, greater than or equals to. This is a minimum inequality. Then we have non-negative constraints. Non-negative constraints. So here you see, these are your non-negative constraints, which means your answer of cookies and cakes will never go in negative. Either you will produce 0 x means cakes, 0 y means cookies, or you will produce more than that, because this inequality is what? Greater than. This is greater than. So this is showing you that the answer of x and y will never go in negative, and you can see the graph itself is positive base because this is origin. So either you will make 0 cakes or more than 0. Either you will produce 0 cookies or more than 0 cookies. So this is non-negative constraint. Are you all getting my point? Okay. Then what we do? Then we graph each equation. And now, keeping in mind constructive response question, one would say that you will not be required to make the graphs because you cannot prepare graphs on spreadsheets. So you will be provided with a graph as you can see right now. So identify the feasible area, feasible region. Identify the feasible region. Okay. So okay. Now, guys, listen. So where is the feasible area? Where is the feasible area? So it's very simple. You can see this is the demand limiting factor line. This is also demand limiting factor line. This is resource limiting factor line. This is also resource limiting factor line. And this is also resource limiting factor line. Okay. Now, where is the feasible area? As all the inequalities are of less than, see, less than, less than, less than, less than, less than. So the most inner region is the feasible area, most inner region. So the feasible area in this question is A, B, C, D. This is the feasible area. Okay. Now, this is the first point. This is the second point. This is the third point. And this is the fourth point. So it's O, A, B, C, D, the feasible area. Okay. Now we need to find out the answer. And as you see here, we can find out the answer using ISO method and inspection method. This is most favorite examiner area. Examiner likes this method, ISO line. Okay. Feasible area I was talking about. You see, all the inequalities are less than or equals to. So the most inner region is the feasible area. Most inner region is the feasible area. Okay, Tayyab? Most inner region, because all are less than or equals to inequality. So the shortcut is to find out feasible area quickly when all the inequalities other than non-negative constraint, okay, when all the inequalities are less than or equals to, the most inner region is the feasible area. Okay. Now it's very simple to figure out. This is the ISO line. You should know what ISO line is. Okay. This is the ISO line. It says explain what the line label C26 and 1.75 on the graph is and what area represented by OABCD. So what you have to write? This represents what? A contribution line. Contribution line. That is 2.6 contribution on X, 1.75 contribution on Y. That's it. Okay. And what OABCD means? It's what? It's a feasible area. I'm sure you should have that basic knowledge. Okay, that is really required right now. It's the feasible area. So those who have the basic knowledge will quickly understand the technique that I'll explain them. Second, explain how optimum production plan will be found. using this line and identify optimum point from the graph. Okay. Now this is ISO line. This line you see is ISO line. And through this line, we can find out the answer very easily, very easily. This is the contribution line. So how will you find out the answer? We will scale up this line. We will scale up this line. That is, if you see, if I start increasing this line further, just check the last point the line touches. The last point. The last point. What do you think? If I starts to increase this line in the upward direction like this, if I start to increase this line in the upward direction like this, the last point that line touches in the feasible area is the answer. Can you tell me which point you think this line will touch? The last point. Yes, the last point that you think the line will touch. So if I just try to make the line straighter, so yes, you can see the last point that the line touches will be C. C. No, it's not B, it's C. If you just increase this line in the upward direction, just don't change their slope. Just don't change the slope. So the last point the line touches is C. Okay. No, it doesn't. Okay, let me just tell you. You have to see the last point the line touches, whether the line is out of the feasible area, but what you have to see is last point the line touches. So if you just scale up this line in the upward direction, you will definitely find out the last point that it touches is point C, and C is the answer. So C is the optimum point. C is the optimum point. So you have to explain this. It's a theoretical question. Explain this. You will say when we scale up the line, when we'll scale up the line, so the last point the line will touch in the feasible area, the last point the line will touch in the feasible area is the answer, and that answer is C. Very easy to find out. Very easy to find out. Farouk, you can scale up by your hand, using a scale. You can judge. You can just move a pen in the same direction of the line. Just move a pen. Just move your hand in the same direction with the line. Farouk, you can figure out that. Okay? It's simple method, Farouk. You just have to scale up the line. Just move your hand along with this line gradient and see where it touches the last point. Okay, let me as this is the best way to find out. So I just saw you just seen here that this is how we scale up. So you scale up the line, the last point it touches will be the answer. Okay, so C is the answer. So you have to explain. You scale up, the last point is the answer, that is C. Simple. Okay, through. Now the last shortcut I need to tell about shadow price in Slack. Shadow price is the additional contribution earned if one unit of a scarce resource becomes available at its original cost. So shadow price is the additional contribution, right? If one scarce resource becomes available. Slack is the amount by which resource is underutilized. You should know the background knowledge behind this, okay? I'm not discussing the background knowledge. I'm just solving the question and telling you the technique how to solve easily. So remember, $1,000,000 points. Shadow price will be of a resource like labor, like machine, like material. Okay. So shadow price will be calculated for all the lines where optimum answer falls. Where optimum answer falls. So let's go back to the graph and let's just clear things here. Do listen. This is the last thing I'm discussing for today. Now, the answer optimum is at C. Okay. The answer optimum is at C. So just tell me at this C point, what are the two lines that are intersecting? So two lines that are intersecting at C is labor line and the demand line. Labor line and the demand line. Are you getting my point? Everyone, labor and the demand line. So is labor a resource? Is labor a resource? Yes. So for labor, you will work out the shadow price. Simple. Simple. For labor, you will work out the shadow price. Are you getting the technique? Remember the shortcut. The lines where optimum answer falls, and if on that point one is a resource line, or even if both are the resource line, so you will work out shadow price. But for that, you should know what shadow price is, okay? So by looking at the graph, you can figure out when to work out shadow price and when not to work out shadow price. So see, where is the optimum answer? Friends, tell me, where is the optimum answer? Is optimum answer at C? Yes. At C, do you see resource line of labor? Tell me yes or no. Yes. And what is the other line? The other is a demand line. The other is a demand line. And this is a labor line at this point. Okay. So shadow price will be worked out for labor only, not demand. Will be worked out for labor only, not demand. We work shadow price for resource. So simple. Let's conclude. When you see the lines where the optimum answer is, if at those lines there are resources, so you will work out the shadow price. So we will work out shadow price for labor, but not for demand, because shadow price relates to resource. And when there are two resource lines, so you will work out shadow price for both the resource lines. But if there is one resource line, so you will work out just for one. Slack. Line where optimum answer does not exist. Whether those lines are resource or demand based. Whether those are resource or demand based, you will work out slack. Simple. So tell me the number of lines where optimum answer is not right now. So it's a beta line where optimum answer is not. It's demand for cookies line where optimum answer is not. It's a single line where optimum answer is not. So all these three lines are a one, whether it's demand or it's resource, you will work out slack. Slack is the underutilization. So you will work out slack. For demand also you will work out slack in units. In units. Unmatched demand units. And for resource you will work out the slack for underutilized resource. So $1,000,000 point, and here we are ending the session. Just listen. For shadow price, it relates to resource only. Lines where optimum answer falls. So if at that point there are two resource lines, so you work out schedule price for two. If it's one resource line, you work out schedule price for one. Clear? Lines where optimum answer does not falls. So all the lines where optimum answer does not falls, whether those are demand or resource lines, you have to work out slack. You have to work out slack. Friends, last thing. Are you ready to answer? By looking at the graph, you can figure out the things. Listen, $1 million point. Quickly tell me. I'm asking you answer certain things. For example, graph is in front of you. Right now you can see the graph, okay? Right now you can see the graph. Now this is a fresh graph in front of you. This is the last test I'm doing. Quickly tell me by looking at the graph. This is the $1 million technique. The optimum point is at C. Is this clear? The optimum point is at C. Is this clear? Come on, tell me. Yes. Now you have learned a very good technique, and that is optimum point is at two lines. Yes. One is demand and one is resource. Yes. One is demand, one is resource. Is this clear? Tell me, you will work out schedule price for demand or resource? Demand or resource? Resource. Yes. This means you have learned the technique. By looking at the graph, you can figure out where will be shadow price and where shadow price will not exist. This is what I wanted to explain. By looking at the graph, you will figure out where shadow price will be and where it will not be. Understood? Okay. The lines where optimum answer is not. How many lines are there? How many lines are there? 3. So tell me, will we work out slack for all these lines? Will we work out slack for all these lines? Yes or no? Yes or no? Yes, you will work out slack for all these lines, whether it's demand or whether it's resource. Whether it's demand or whether it's resource, you will work out slack. Understood? So by looking at the graph, now you can figure out where shadow price will exist and where slack will exist. Yes or no? Is this technique good? Is this technique good? Tell me yes or no. Okay. So I hope you like the $1 million point. You like the $1 million technique, and I hope it's clear. Do watch the video. Thank you very much for today's session. I hope today's session went well for all of you. I did said when you see the lines where the optimum point doesn't falls, so on for all those lines you will work out slack. For all those lines you will work out slack. Okay. Okay, thank you very much for the session. I hope you like the session. Give your feedbacks. See you tomorrow in the next session with very important area of performance measurement. Thank you very much. Take care. Bye.